I've been investing for almost 13 years, and I just watched 5 TikTok videos that are helping beginner investors start investing. Some of this advice is exactly what I did, but some of it is genuinely concerning. So let me break down what's helpful here.
Tell me the 3 best stocks to buy to get rich.
Well, actually, I'm going to give you 503 you should buy.
Isn't that going to take a while?
Well, just remember VOO if you're in the USA or VUAG if you're in the UK.
Wait, what are you talking about?
These are index funds that track the S&P 500, and by buying one, you get a slice of 503 of the top US companies such as Tesla, Amazon, Google, and Meta.
So he's making a really good point here. Basically what he's saying is that you're not going to actually select an individual stock, but you're buying a basket of stocks, which he's talking about is VOO, V-O-O, which is a ticker symbol for the S&P 500, which is one of the best ETFs to buy on the market. However, there's more to the story than just that. So I think it's a great starting point to invest in the S&P 500 fund, but I've said that before and I've gotten shot down when the market goes down. Naturally, you're going to have a lot of volatility with this portfolio if it's just one ETF. While you own the top 500 stocks in America, the problem is when there's a recession or a pullback and you don't have full context, that's what gets you in trouble. If you click the video in the top right-hand corner, I'll give you the context behind this entire story. All right, let's watch number 2.
Here's the power of investing in a Roth IRA. As of 2025, you can contribute up to $7,000 per year to a Roth IRA. If you can generate an 8% rate of return, here's how much money you would have over time. If you contribute just $10 a month to a Roth IRA, after 40 years, you'll have $32,000. If you can bump that up to $50 a month, after 40 years, you'll have $160,000. The more money you put into a Roth IRA, the more money you'll have over time. And if you can max out your IRA for 40 years, you'll become a tax-free millionaire. If visual explanations like this are useful, follow me.
Brian is awesome. I know him personally. I've talked to him a lot of times. He is a great explainer and great teacher of compound interest and finances altogether. This is a great visual because it actually shows you how small amounts equal large amounts long term. You don't have to be investing thousands and thousands of dollars a month to get actual returns. Your returns start day one. So when you begin investing, your compound interest and all of your dollars begin to work 24/7 for you forever. Once you understand that, you'll begin to apply this. The other thing that's really important is the taxes on your passive income that you're earning through investing. It's about half of what you're paying right now on your active income. The hard work that you spend every single day at your job, you're paying 2x the taxes on that income versus this passive income. It only makes sense.
The stock market is near all-time highs again, and the biggest mistake I see people...
The best thing is I'm watching this a little later than when it was posted, and he says all-time highs at 6,000 in the market when I'm recording this is at 6,300.
making is that they don't invest because they would rather wait to see if it drops a little first. Now, this is actually a behavioral bias because
Humphrey hits us right on the head, and I talk about this all the time. We have a lot of data to suggest why this is a horrible idea to wait to invest because it's at all-time highs. And data actually suggests typically when it hits an all-time high, 12 months later, it's at another all-time high. So it only makes sense to continue to invest, and if it does fall back, that's okay. Because if we're dollar cost averaging, that's when we make the most money, especially when it falls back and there's volatility. You want to embrace the volatility. You want to embrace the downtimes. That's when you actually get wealthy.
The S&P 500 spends about 8.3% of trading days at all-time highs. That's roughly 21 days per year when it's at a record level. New all-time highs are usually followed by more all-time highs. And
See, I told you.
If you're not invested on the big days when the market is up, you actually miss out on a lot of the gains. If you miss just 10 of the best days in the market in the past 30 years, you could erase your gains by 54%.
I'm going to pause there and show you how significant that statistic is he shared. If you miss 10 days over 30 years, by the way, if you time the market, you're likely to miss those days. Here's why. 8 of the 10 best performing days came after the worst performing days over the last 20 years. That's not just the last 20 years, that's a trailing 20-year average statistic that you always see. So typically when people think it's the worst time, it actually becomes the best time. And if you just miss those 10 days over 30 years, you're going to lose 54% of what you could have had. It's not worth it to time the market. Dollar cost average into low cost ETFs for a long period of time, and you're going to win the game.
20 days will cost you 73% of your total gains, and missing 30 days will result in 83% less.
Paying a 30 days out of 30 years, just missing those days will crush your returns. We're talking millions of dollars of difference. Do not play that game. It's not worth it. So when everyone panics, stay calm, stay invested, and stay in the market long term, and you will do phenomenal.
Paying a price no one has ever paid before definitely creates psychological resistance, but that's exactly when disciplined investing matters most. So to be a better investor, you want to simply dollar cost average, which means that you should be investing a certain...
Sounds like Humphrey and I are on the same page. Dollar cost average, ETFs, stay invested, the same principles apply. These are universal. These are timeless principles that always win with good investors. Humphrey knows what he's talking about.
amount of money at a regular interval of time, and that way you take away all the emotion out of it. Follow me for more tips.
This was a phenomenal video. It broke everything down, and as to why people struggle with money, it's because they can't stay still. One of the best hacks to prevent yourself from doing something silly in a down market is to automate this entire process. I talk about automated financial systems with my students, and when the market drops, it doesn't matter how much education you have or how long you've been in the market, there's psychology that is at play that could hurt you. And if you don't set yourself up for an automated financial system that's doing everything for you, and you're not making manual decisions based on the emotions of the day, then you're going to struggle.
The pro tip: if you have credit card debt and you can't pay the bill in full, don't worry. You can still set up an automatic payment. Don't you?
See, Ramit's already talking about automatic. We are not good at manually doing this. Anybody that has been through Budgetdog Academy knows that we set up automated financial systems. Everything is automatic. We spend less than 30 minutes a month for a reason, because if we're doing all this stuff with our money, we have decision fatigue, we have more decisions to make, and it's going to get confusing over time, and your emotions are going to rule, your biases are going to rule. There's a reason he's talking about automating your credit card payments.
Dare set it up for the monthly minimum. You better be paying more than that on a 27% interest rate.
And yes, all of your money in this situation, all of your free cash flow should be going to your credit card payment, especially if there's a 27% interest rate. You should not be investing, not even the match in the 401k. And that's controversial, but the reason I say that is because it's not a math problem. This is a behavior problem. If you have credit card debt and you're paying 27% interest, all of your free cash flow should be going to that until it's paid off. And if you have an issue, stop using it.
Pay more than the minimum, but importantly, if you can't pay everything off at once, I'm not going to beat you up. I would like for you to pay that off aggressively and then never get into credit card debt again.
It's almost like they're saying it after I've already explained what you should be doing. The reason behind that is because these are financial professionals that are all on the same page. There's a lot of different methodologies you can use, but when it comes to investing, when it comes to credit card debt, most of our advice is exactly the same because there's fundamentals to this game. The reason I wrote The Roadmap to Financial Freedom, A Millionaire's Guide to Building Automated Wealth, was specifically to address the fundamentals of wealth building. Anybody can build wealth if they focus on the fundamentals. The problem is everybody's trying to get the quick tip and trick and trying to do all this acrobatic stuff when you don't have to do that to win with money.
If you're new to investing, don't skip this video. I'm going to tell you how I would invest $150. You've seen some of my other videos, and you know that I love investing. I love to talk about investing. I've been doing it for almost 10 years now. And during that time, I've grown my portfolio from $150 to $280,000. So with $150, I would be looking strictly at ETFs and mutual funds. If you're
And another wise individual says ETFs and mutual funds. Index funds, what we talk about. Actively managed mutual funds, not a chance. Passively managed index funds, yes.
I'm familiar with what those are. They are a method of investing into a basket of stocks. So with an ETF, you're going to be investing
Basket of stocks.
typically in hundreds of stocks, as opposed to...
And just like Mark said in the beginning, you're investing in hundreds of stocks, sometimes thousands. So if you own something like VTI or VXUS, you actually own thousands of stocks. Typically, an index is going to track the index itself, but oftentimes you can actually select an ETF or an index that's going to select a specific sector of the market.
just investing in one. Now, the advantage of this is that it offers you diversification, so you're not weighing the performance of your portfolio simply on one company or on one stock, but instead you have hundreds of different companies that are in your portfolio.
And I'm going to stop there because that's a very important concept that's talked about a lot, but I don't think understood why. So if you're not reliant on one stock to outperform everything, you're not going to be so reactive every time the market goes down because you know you're protected by the diversification of thousands of stocks. So you don't have to rely on like the one unicorn. And this is why we don't individually invest in stocks, because there's no reason to bet on one company all the time, because you start to become reliant. And when you're reliant on something, you start to become very desperate when it goes the opposite direction of what you expect. This is why we use ETFs and index funds.
Starting out investing, I was new to investing. I had $150. I would invest the majority of that into QQQ. I talked about QQQ in basically...
I'm going to stop there. I would not use QQQ. If I were to go that direction, I would actually use QQQM because it's actually 5 basis points cheaper, but the same holdings. He does not know that.
Every other post. And QQQ is a ETF that looks to track the Nasdaq. I believe there's 102 stocks within that fund, and a bulk of the companies held within that fund are tech companies.
And here's the other thing about QQQM or QQQ is that it's only holding about 100 stocks and it's tech focused. So therefore, you're going to have a lot more volatility than an S&P 500 index. So you got to understand your risk profile, what you're willing to risk for the potential gain. And most people, when they're doing these analysis, they're only thinking about the potential gain. They're not thinking about the potential risk that does play out from time to time.
Aside from that, there is consumer goods, and then there's also, I believe, healthcare within that fund. So if any of those areas sound interesting to you or you want to invest in those areas, QQQ might make sense. Alternatively, if I didn't want to invest in QQQ, I would put that money into SPYG, SPYG. I've talked about a fund called SPY. SPY is an ETF that tracks the S&P 500, which is the 500 largest companies within the US. SPYG is going to be the growth version of SPY. So it's going to be more focused on aggressive growth. So I guess an example.
And I also want to stop them there. So SPY is actually more expensive than VU, and they're the same exact holdings. Now, I know he said SPYG, which is the growth version of the ETF, but VU would be the better alternative from a cost perspective. Same holdings, same performance, cheaper ETF. Makes a lot more sense in that situation. But the other thing is he talked about taking out just the growth portion. So when you invest in an index like the S&P 500, whether it be SPY or VU, the thing is that has value and growth, which is a blend of both. Now, if he's saying just the growth portion, he's saying, hey, I'm a young investor. I want to take on more volatility. I want to take on more risk. And that's what he's bringing up here, which is nothing wrong with that. But you have to understand what type of investor you are before you just go that direction. Me personally, I like a blend. I don't like to bet on value versus growth. They're both going to have their time.
Example breakdown of the 150 would be 100 into QQQ and then $50 into SPYG. Alternatively, I can do 75 into QQQ, 75 into SPYG. This way, not only am I getting exposure to the stock market through these different indexes, but I'll be investing in technology, which has been performing well of late. And then I'd also be diversifying.
He said as of late. That's the other thing. Technology did great. It has its run. But of the 11 sectors of the stock market, you have to realize that they're all going to have their day. And that a blend of all of those is usually better for the average investor because we don't want to bet on each sector. It's not worth it, in my opinion, because one day energy is going to be up, one day consumer discretionary is going to be up, one day tech's going to be up, and they all have their turn. It's just not worth it.
Diversifying into the 500 largest companies. Many of those are tech, so there would be overlap. It is worth considering that the top holdings of SPYG and the top holdings of QQQ overlap, and there's a lot of similarities. And so for that reason, realistically, if I were starting out investing at $150, I'd probably do 100 into QQQ because I love QQQ, and then $50 into SPY, which is...
He's speaking a lot of facts, and this is really good. But when he says, I love a specific index, that's a lot of emotion that goes into that. And emotionless investing is your best type of investing because you don't have feelings towards your investments. Your investment should be as boring as watching paint dry. You should automate this process. It should go into quality ETFs and index funds, like he's saying, and you should not have any emotion towards that. Because if you do, what happens is you manually go in there and change things when the times shift or the economy shifts, and that's not what you want to do. The other thing he mentioned was the whole point of this video is how much I would invest with $150. So the risk level isn't high. If he loses $150, which he won't, it's just not as big of a deal. But when you add an extra zero to that, 2 zeros, 3 zeros, that risk gets a lot different to the individual that's investing. So if I took the same approach with my current portfolio that's over $3 million and it had the same volatility that this portfolio will naturally have, that could be disastrous depending on the type of personality I am, how long I have until my goals, what my risk profile is, what type of individual I am, and what I'm trying to accomplish. So you got to be careful with the dollar amount and the amount of risk. He's saying 100% equities and somewhat pretty risky equities. And when I say risky, I mean highly volatile equities. And so you just have to understand that just because somebody says this is the way does not mean it makes sense for you. When people ask me what to invest in or what am I invested in on IG Lives or something like that, I always have to scale back and say the context before the actual investment, because it's irrelevant what I invest in. It's irrelevant what my goals and my risk profile is and my timeline is comparatively to yours. So you got to be very careful with general advice like this. While he means well, he's talking facts, it's definitely not always applicable to somebody. And sometimes you might need real estate or bonds or other types of assets in your portfolio to balance your volatility out.
Another ETF, again, I've mentioned that it holds the 500 largest companies in the US, and that would be my starting portfolio. Another alternative is if you didn't want to invest into funds and you wanted to invest into individual stocks, you could just pick any company that you know, any company that you like, and then invest in that. For example, if you love Chipotle, you could.
I personally think that's horrible advice. I understand it. Again, he means well. I think his advice, generally speaking, is pretty solid, but just investing in something because you understand what it is, like Pepsi or Coca-Cola or Chipotle, like he mentions here, does not mean it's a good quality stock or investment. Just because it's every day, you see it at Home Depot, things like that, does not mean you should be investing in it. You have to understand the fundamentals behind the investment. If you go the individual stock route, which, by the way, I had before with Meta, and it was a phenomenal investment that's had 600% plus returns since I've invested at $97 a share. That was because my background at Deloitte allowed me to understand 10Ks and reading fundamental reports to actually get real results. And even at that, somebody that's actually experienced like myself doesn't bet on individual companies much. This was an obvious one when it dropped about 70% in 2022, and there was a major pullback from one of the best companies in the world fundamentally with a lot of free cash flow. But again, if you don't know how to read their financial statements and make fundamental analysis decisions, you are going to struggle with individual stocks. It's not worth it. However, he is speaking some common sense here as well.
Put the 150 in Chipotle. Kava, you could put the 150 in Kava or Lululemon or Microsoft or any other company that is traded on the stock market. I've had people ask me about Roblox. You could invest in Roblox if you wanted to with that 150. At the end of the day, I think it's easiest to invest either into a mutual fund or an ETF or into something that you know, a company that you know whose products or services you utilize. And so for that reason, if I was starting out today with $150, I would put 100 into QQQ and then $50 into SPYG. Through my experiences over the past 9 years.
There's also a lot of overlap with those two ETFs. So it's not that there's anything wrong with it, but if you have a lot of correlation with your investments, it just makes it a little less effective, and it kind of waters down the idea of having multiple funds if it's not going to be totally separate type of funds, because there's a lot of overlap with index and ETFs since they all hold thousands of companies typically.
Years, I found that it's just more balanced of an approach as opposed to investing in individual stocks.
And if you go in my show notes below, I'll give you a ETF Research Center portfolio overlap tool that you can actually check your overlap within the ETFs that you hold.
If I could go back in time, I would have put more money into funds as opposed to individual stocks because my portfolio doesn't always perform as well as the market because sometimes I have too much tech. Tech underperforms relative to the stock market. That means my portfolio underperforms relative to the stock market.
See, I like the honesty here because he's saying that he typically underperforms or tech doesn't perform as good. And that's the case I was making earlier and why you shouldn't take a bet on a specific sector or heavy, load your entire portfolio into the tech sector. If you're just in an S&P 500 fund, your exposure to tech's already 30% of your entire portfolio because that's what the S&P 500 is made up of. And I would expect that to slowly increase with time due to the type of companies that are coming out. And so when those are replaced, I think tech will naturally increase. And I think that's why the S&P 500 fundamentally makes so much sense. It's going to take in account all of the changes in the economy, and all of the competition will rise to the top, and that's what you're going to get with an S&P.
Okay. So I go back in time. That's one of the biggest changes I would make. And so if I was starting out today, I'm going to say this last time, I would split my money between QQQ and SPY. Hopefully that's been helpful if you're looking to learn more about investing.
Overall, solid advice. I do not think that this is bad advice, but I definitely do think that you should think bigger and deeper about this. And this is where the context comes into play. This is where my YouTube comes into play. This is where my podcast, Money on My Mind podcast, comes into play. And all of the really, really deep understanding of investing is important before you start your own portfolio. However, don't let fear hold you back from beginning today. Look, here's the truth. All 5 TikTokers make really good claims and have really good advice here, but only one strategy will work for 99% of the people watching this. So if you want me to show you my exact system to turn $150 into $1,000, drop a comment saying system below. And if we hit 1,000 comments, I'll make that video next week.